Our market wrap guest is a guest who's been thinking things have changed a little bit in the past 2 weeks. She's Diana Avigdor, portfolio manager and the head of trading at Barometer Capital Management. Good to have you with us.
Thank you very much for having me.
What has changed?
A couple of weeks ago, we talked about the market and we said that while we were constructive, I really was fearing a lot of volatility because don't underestimate the power of money flows, especially when interest rates tend to change. When interest rate policy changes, things can get messy, especially as interest rates rise after a period of 5 years of monetary easing and support. What changed in the last 2 weeks has been an acceptance of Fed policy and a final realization and an understanding that what everybody calls tapering is not tightening, and that it's so data dependent. Bernanke has again been able to communicate transparently what he's thinking about the markets, have relaxed a little bit. Now, yields have not gone back to where they were before, but I think that the volatility with which we're going to reprice the risk, and we have repriced some of that in the last 6 weeks, the volatility with which we get there is probably a little more benign.
How much of it have we repriced and how much more still has to go? Because the markets are still on fire.
Yeah, well,
the U.S.
That's right. And Canada is not doing too badly either the last little while. Look, since 2008, over $1.1 trillion has gone into the bond market, and the equities have lost about $450 billion.
So this is the great rotation.
Yes, but we've been talking about this great rotation for several months, except that it has come from money market. Money markets are still losing funds, but now we're finally seeing evidence of flows coming out of the bond market. And you know, with portfolios that have been so conservatively positioned over the last few years, you know, if you are an individual in the need of yield, and you are 80% yield and 20% risk being equities, if you take some profits there, and I think that as people see their quarterly statements, I think that there is some rejigging and you're seeing some of those outflows. So
there is, of course, still a place for bonds in one's portfolio. Certainly. You're not advising that.
Certainly, I'm not advising anybody that is on a fixed income or that needs yield. Bonds have a room in everybody's portfolio, but bond funds can be as volatile as equities when rates go up sharply. Not so much if they don't go up fast, but bond funds will get hurt, and especially if you're sitting on some profits and you have a large proportion of your portfolio, it would be wise perhaps to move a little bit into equities, which offer same kind of support in terms of yield, or some support in terms of yield, and some capital growth.
We saw yield plays by and large under pressure today, and so it's a sort of a flavor of the day kind of thing. Sector-wise, where would you be rotating out a portion of your bond portfolio into the equities? So
you see some very good stocks that offer a good yield, such as the financials, U.S. financials, and now Canadian financials as well. Companies like GE, GE offers a 3% dividend yield. It has also publicly announced that it wants to decrease its share count by 10% by 2016. It has paid back already a little less than $10 billion to shareholders in the form of buybacks and dividends this year. So you're getting a large company with diversified divisions that has bottomed out, that is doing cost cutting, and is paying you to hold the stock.
But what about the top line? Because we can see the EPS figures massaged by better profits, but also by, as you point out, stock buybacks. It's the revenue line that we haven't seen significant growth in the earnings season so far.
Exactly, and to your point, and multiple expansions, we've seen that. We've seen ETS, and we've seen some because of the cost cutting. That's exactly what we're waiting for, is the revenue growth. And so in terms of how you position yourself, you want to position yourself in stocks that are not interest rate sensitive, but economically sensitive, economic growth sensitive, things that speak to through a second or third derivative through the consumer. We're still like the home building play, but through Home Depot, which offers you all a very good pricing environment, as it does not really have a competitor.
Home Depot was already up 61% in the last year. How much more upside can you see? It only pays at what, less than 2% dividend.
It does pay less than, but it plays on a housing play. There are expectations for earnings and EPS repricing. So as the housing market, which is coming off a very big bottom, continues to play out, stocks like the home builders have taken a bit of a beating, like KB Homes and Lennar. That's not where I would prefer to be. Would prefer to be in Home Depot, as it has a very good pricing environment. There's no fear of a Walmart in their business. There's no fear of an internet in their business, of anything changing there. And so we've been holding it for a while.
So then how far up the food chain on the housing story would you go? Would you go to the banking sector, which is providing the mortgages?
That's right. So the U.S. housing, the U.S. financials also play on that theme indirectly, but also, for example, Wells Fargo is well capitalized, above the minimum levels. Bank of America is cheap. We like, in terms of the equity market, so that's the housing theme, as well as the general banking environment. And with rates going up, net interest margins maybe moving up, but not just yet.
All right, so Wells Fargo, by example, as we see it at 44 and change today, is trading 1.6 times price to book, whereas Bank of America is still below book value.
That's right.
Would that not be the better play of the two?
Well, we barbell. So even in terms of, in Canada, we like the, you get the expensive one. Stocks are trading expensive for a reason. Either there is a catalyst coming or some expectations of a repricing, and that's why it's expensive. And so you buy the cheaper one. For example, Bank of America is trading below the book and below its peer average. So we have both, for example. In terms of Canada, just on the same vein, in terms of the asset managers, they also benefit from this kind of environment. So you look at an asset manager like CI, which is more expensive, and you look at an asset manager like IGM, which is cheaper and has come a little slower up the fund flow curve and the performance curve, so it's cheap. So you get the benefit of getting the best of breed that has already been working and it's already paying back. CI has increased dividends, twice this year already, and IGM is just at the beginning of that performance structure.
Diana, thank you so much for coming in.
My pleasure.
Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management.